Morning, everybody. It's Thursday, November 30th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you have any questions or comments, please feel free to drop us a line there in the chat area. You can also email us at info@agyield.com, and we'd be more than happy to address your question during the session. Real quick, overnight markets, we had corn up 3 1/4 at $4.53 for December. March soybeans were down 1.5 cents at $13.64, and December Chicago wheat was down 1/4 at $5.55 3/4. This morning's export sales report, pretty friendly across the board. 1.9 million for corn. That was at the high end of the estimates. They were looking for like 1.2. Beans were 1.8 million, a little over 1.8 million. That as well was higher than the higher end of the estimates. And wheat was 662,000. We also had a sales announcement from the USDA here this morning, 134,000 beans to China for 23. So with that, I know we mentioned yesterday at the end of the show that we were going to talk a little bit about our views on the corn and bean ratios, why it is we look at those so early in the season, and how that relates to old crop ratios versus new crop ratios. To kick us off this morning, Jason's going to give us some thoughts, and then we'll move it around the group here.
Yeah, appreciate that, Dan. Yeah, when we're looking at old crop corn and beans, and Dustin and Justin mentioned this a little bit yesterday, but as we're looking at old crop ratios, they really matter less and less after we have the crop, right? So the ratio can't really influence the farmer on making decision of planting the new crop, right? You have that crop, you have it in the bin, or you have it sold, and they're really, unattached from each other. But when we're starting to look at new crop ratios, that can have a big effect on what we plant or what we intend to plant for next year. So we're looking right now at a November 24 versus Dece 24 ratio of like 2.55. That ratio in a normal year, let's call it, kind of hovers around a 2-3 ratio, and that would so we're looking at a higher ratio, I guess, going into 24. We could see us picking up a lot of soybean acres. A couple of reasons for that. We had a heavy acres number for corn last year, maybe a lighter one for beans. So just a natural rotation back to a heavier bean number we could see. A lot of that has to do with, as well, of low corn prices. So when we're looking at $5 corn, you're looking at break evens, right around there, or maybe even higher than there. And then you're looking at soybeans at $13. You're going to have some decisions coming into the spring if these ratios stay that way, and if corn prices stay low. If you want to plant more beans, or if you want to take the risk, I guess, of planting more corn, at a lower starting price. So I think there is going to be a lot of pressure to plant more beans if something doesn't change. And there's a lot of time, right? I mean, it is early. A lot of these decisions haven't necessarily been made yet, but they're starting to be talked about, right? I mean, guys are talking internally at their farm with their partners. They're having those conversations with their bank, and that's going to continue. And like I said, this could all shake out a little different into the spring, depending on what South America does, depending on what corn prices look like in the spring. But for right now, what we're looking at, our opinion would be we could have a major shift into more bean acres. Anybody want to add to that?
Yeah, I would add to it real quick. To that point, history shows that the higher the flat price goes, people like to plant corn. You get more bushels, a lot of revenue. And so the bean ratio has to go much higher to corn to try to compete for acres with corn when you have high prices, good profitability on all crops. To this point, Jason, and we've seen this, in similar years when you're crunching margins, right? People will still try to plant corn. Like right now, the conversation is, my break even's 5.10. Should I start selling some here, even though we're at break even? What ultimately comes when they talk to their banker, it turns into total dollars available, right? So if I can switch, 20% of my acres and save a couple $100 an acres in input costs, on those acres to make the total farm expenses down somewhat and go into a little bit higher bean rotation, especially after being a little heavier corn. Those things kind of naturally happen. Now we do have we have shifted to a, pretty good 50-50 rotation for a lot of really good operations, even in, high productivity ground in Illinois, Iowa, mostly because bean yields have caught up to corn yields in the last, 4 or 5 years in a lot of areas. So yeah, I mean, Dustin talked about, some kind of a, 89 type number for both. I think that's kind of a fair number here. The highest I've seen the ratio going, pre-planting, I think was 2016, 17 in there is about 265. So we're close to that kind of very top end of the range of where that ratio is pre-planting. After planting, after people made decisions, like you said, ratio really doesn't matter anymore because it's already been planted.
Yeah, what I always find interesting too is how easy it is for us to buy corn acres back, right? If there's a problem, the market can rally corn really quickly, and we've seen this in years past where farmers are willing to go out and plant corn late. If the mentality is, hey, corn's bullish all of a sudden, right? So I think the market doesn't need, if it feels like it doesn't need corn acres, and something were to change, it knows it can go buy corn acres really quick. And that's a lot harder to do in beans. So it kind of makes sense to me, as we sit today, that we would have this high ratio.
Has crop insurance, the question, guys, has crop insurance contributed to some of that decision too? With some of these Cadillac policies and things of that nature?
Yeah, Dustin, you could add to that, I think pretty good.
Yeah, I think so to a certain degree. We saw this a little bit, last year. It's like, there was still kind of a decision for acres. And I don't think it's a big decision at the end, but it's like, what policies have they already bought going into that planting window? Because the sales closing date's March 15th. I think it'd be hard for me to quantify how big of a difference it would be for crop insurance. But, sometimes, like, let's say if your loan is based on insurable value, then you really ought to plant corn in some cases, because your high productivity corn, you've got a high APH just because the history is there. And you're kind of bound to that just to get total insurable dollars high enough. So that's one thing. The other I would say too is, we are at a 2.55 to 1 beans to corn ratio for new crop 24. And I know that old crop and new crop are completely different animals, but old crop ratio is 3 to 1. So I do think in part the reason why we're a 2.55 to 1, and that's just simply no 24 beans divided by D's 24 corn. That's how you get to that ratio. The reason why we're up to that ratio, which is an elevated ratio, has a lot to do with current tightness in old crop. And that bleeds over. So I think a lot of people that might be looking at a 450 price yesterday and today for D's 23 corn and saying, hey, I'm not going to let that happen again. I've got a 505 price set for D's 24. Even though that might be 10, 15 cents below their break even, they're still maybe a more willing seller when they're looking at today's price at 450. I think as people start to dig into their balance sheets and see margins, as we mentioned yesterday, margins are pretty tight. That there's not going to be a plethora of extra selling in D's 24 corn until they have to. So, I still kind of lean towards, doing both those numbers. If you have a 50-50 split, there's some unique ways to maybe just get a little bit more aggressive on bean hedging and less aggressive in corn hedging in some cases.
Well, I mean, Dustin, to that point, we just went through first notice day, as we've talked about a lot. Going into first notice day, spreads completely tanked to probably the widest they've ever been for D's March, 27 and a quarter traded yesterday. We're talking about farmers selling a bunch of $5 corn next year. We had $6 corn for months and months and months that weren't sold, and a bunch of corn was priced at 450 on the last day, right? So to your point, I don't think the appetite's there to see how much corn we can sell at $5 with a bunch of unknowns. That doesn't mean it goes up a bunch. But to your point, the structure of the market's got a huge carry in corn, an inverse in beans. causing a 3-to-1 ratio nearby, and 2.55 in the deferred. But it is creating that opportunity where, can that ratio go higher in new crop? If South America runs into any kind of problem, I would say yes, because the market will kind of panic short term on getting enough bean acres here, right? Like it's going to want that 6-7 million acres switch, I think, because we are so tight to start, right? It doesn't want to go into year 2 if there is a big South America problem. And corn obviously has a big, we have record wide carries, plenty of supply right now. It's just not going to be in a panic mode, I don't think. And that's probably why the ratio is where it is to start.
Yeah. And just to add to that again, at some point, if we are carrying in too much corn from old crop, it really doesn't matter to your exact point as well. If we're carrying a 2.4 billion bushel carry in, we don't need 93 million acres of corn. We can probably get by with 89, no problem. Just because we've supplied next year's demand with this year's crop to some degree.
Mm-hmm. Right.
Is that where, I know I'm not sure if we've updated balance sheets and stuff like that. Is that where are we thinking 2.4, that some kind of number like that as we sit here today?
Certainly possible. Yeah. We're going to get the final numbers in January, and it's where demand comes in at. We had some pretty good export sales this morning, obviously. Corn export sales have not been that bad, even though shipments have been kind of slow out of the Gulf. It all kind of comes down to exports, really. Like what, in my opinion, like can exports, finish out strong or not?
Yeah, no, I know said. One quick thing I wanted to highlight too, and we touched on it just a little bit yesterday that we were going to talk about it, but just the dollar index has really been falling apart. I know it was up a little bit here today, but generally has been breaking. Any thoughts there, guys? Just on the overall bigger picture commodity play there with a breaking dollar.
Yeah, typically when you see the dollar weaken for an extended period of time, right, it's friendly dollar-based commodities.
Right.
The short run supply and demand really trumps that, in my opinion. Good commodities will be good, bad commodities will be bad. But a falling dollar is it's a tailwind, not a headwind, right? We've had the sharply rising dollar, rising interest rates, all these macro things have been, basically headwinds. So a big break in the dollar is certainly, helping that cause to the commodity basket. Does that save commodities that have too much supply? Probably not.
Right.
But it certainly doesn't hurt. Let's put it that way.
Right. Yeah. No, it's like you look at gold back over 2000 or whatever, and it's like, is it a bigger sign maybe of an overall opinion that in some of these outside markets that they want a little bit more safe haven versus, some of the volatility that could potentially be down the road as we go into the new year.
Yeah, I would add to it too, because Jason made a really good point here a week or two ago about a lot of it really is real. Watching the real, if the real continues to rise against the dollar, then that's a tailwind for beans, especially because we become more competitive very quickly. So right now we have had a pretty good fall in the dollar, rise in the real up until last couple of days are starting to fall back a little bit. So that's just something to maybe watch, is if that trend starts to change, and you start to see some weakness come in beans, go back and look at the real, see if that might be somewhere where that's coming from.
That's really good.
Yeah, I would add to that too, just interest rates in general. It seems like there's more of a consensus that maybe we pause here for a bit, if not, even cut rates a little bit first quarter. Obviously, that's a huge debate and see what inflation does and all those things. But maybe some of those really strong headwinds that we've had, maybe are at least pausing for a bit, which would be welcomed.
It'd be nice going into renewal season, right? I think the farmer would be a welcome reprieve if we get a cut in some of our inputs and then potentially a little break at the bank. That's not going to suck for anybody, right?
Yeah, absolutely.
Coming into the open here, fellas, any parting shots or last minute thoughts as we go in today? I know we were talking a little bit about deliveries this morning. It didn't seem like there was anything really eye shattering. Justin, on your front, I saw no corn deliveries, but anything else that caught your eye?
No, I mean, I think it's, there are a lot of talk on social media about these spreads. We've been talking about it, obviously. Even when we've talked about levels that we thought they could get to, when they happen that fast, it's still kind of shocking. So if you really weren't paying attention, it's probably really shocking. And I think the corn spreads did what they had to do to not get deliveries. They went past full storage. They traded, so full storage, 8 cents a month, 24 cents. They trade all the way to 27 and a quarter. So now you're getting the level. There's not a huge incentive for commercials to deliver, right? To give up their storage or their ownership of those warehouse receipts, right? So you can earn interest. You could earn interest by stopping some corn. So it accomplished its mission. Unfortunately, a lot of long basis contracts had to roll at historically wide levels. It's going to cause a really uphill battle for those naked basis longs, right? The market's it's just a tough environment to just keep rolling, because now, if you rolled the March, right, you have to make 25 cents. You have to rally 25 cents just to break even. If to July you got to rally 45 cents just to break even. And those are in a normal year, those are kind of normal seasonal rallies for the year. And you've got to rally that much just to break even. So tough environment for sure for your people that don't have storage. It's gonna be tough on the market unless there's my opinion, unless there's a major supply shortage or new demand thing that pops up,
which we'll be keeping our eye out.
I'll add to that. Just the funds are, and you mentioned this yesterday, Justin, right? This is the market's funds love to sell. Because they get to earn that carry. They get to, roll it, stay short, roll it. So we saw funds piling into this break as well, right on top of this first notice day. Maybe we shake some of them out short term, but it's going to take a lot, I think, to convince them that all of a sudden corn's bullish, right? I mean, I don't see that happening. So they're in the money. They've got a big winning position on it, just like wheat. So the market's paying them to be short. Yeah.
And it's disincentivizing someone to be long. So until that's a tough thing to turn. It takes time and pressure, as we like to say, right? So you've got to start. Maybe today was the beginning of some, we're breaking into maybe some real demand, close to 2 million tons a day or this week. So maybe we start finding that demand, maybe the buyers way underbought, that could be possible too, where, hey, what's the point of reaching out? Maybe they've been hand to mouth. So things kind of feed upon themselves. If there's a little bit of a story, maybe you got to get some real buyers to come to the table. So things can turn, obviously, quickly. But right now, it's a tough setup for sure.
All right, very good, fellas. We've got December corn up 4 1/4 here, 4.54. Jan beans are down 6 3/4 at 13.40 1/4, and December Chicago wheat is down 1/4 at 5.55 3/4. We are now streaming live on YouTube, X, and Facebook Live. Please don't hesitate to subscribe. And we appreciate, as always, everybody tuning in, and look forward to wrapping up the week tomorrow with everybody at 8:15 Central Time. Have a great day.
All right. Thanks, Dan.
Thanks, Dan.